Hi everyone. In today's episode, we're going to take a look at the rupee. Specifically, given the fact that the exchange rate continues to weaken and the rupee is now at 84, I personally wonder whether we're getting poorer in dollar terms every year, and especially that matters given that so many of our expenses are actually based in dollars. And I keep wondering whether investing in foreign stocks or dollar denominated stocks might make for a better investment if there is this 3-4% uplift happening every year. So, to answer these questions, we're bringing in Deepak and let's see what he has to say. Deepak, this question has stayed with me for a long time. You know, when I left for college in the US, I think it was August 2005. I was very sensitive to the exchange rate back then, and I think it was $43 rupees to $1. 2 years later, the Indian stock market, I think, had doubled, if not once, maybe twice, and the exchange rate had even become stronger. It had gone from 43 to 39. And I was wondering if I had made a very terrible life choice by going abroad and dealing with all this, when clearly all the action was happening here. But then obviously I jinxed it for decades. And as you can see, since what, 2007, it's been almost a straight line. I mean, I know it's been volatile, but let's just go with start point and end point. In 2007, it briefly hit what, 39 perhaps? Yeah. Today, it's 84. In some horrible symmetry, it might soon be 93. And this seems to surprise no one, I think, and everyone seems mostly at peace with this. So I'm coming at this, I really don't want to make this about institutions, RBI and macroeconomics. I'm coming as an investor or a customer of Capital Mind, even though we will have to address all those points. If this is the case, I know for a fact that whether you recognize it or not, a lot of my expenses and your expenses as well have a dollar component to them. So am I just getting 3-4% quietly or secretly poorer every year since I'm losing against that exchange rate? And the second, 3-4% is pretty big. I mean, if we had that much alpha in a strategy, I mean, we'd be pretty happy. So if do you get that for free by should I start Capital Mind US and start investing in global stocks and move all our customers there? What do you have to say to this?
That is a great point, because I think the fact is that you've probably been one of the few people who has seen a period where the rupee has appreciated at least 10-15%. And it is surprising to most people today that, oh, well, the rupee can appreciate as well. But you saw it firsthand at a time when perhaps, it was not considered that surprising. But remember, the rupee was at 39 in 1998. And in 2007, 9 years later, it was still at 39. Wow. So person in 2008 is probably thinking there is no depreciation. I mean, there is some depreciation. It went to 46 and came back, but you were the 10 years of nothingness, right? So the rupee does appreciate, and I think it's something that is not wrong. It's perfectly fine. But here's the interesting thing. At the time that you were there, and it was 2004 to 2007 actually, it went from 43 to 46 sometime, and then, or rather it was 46 and came back to 39. It happened despite the RBI's best attempt. And I'm bringing the RBI into this because it is the elephant in the room. And my feeling is that to a large extent, it has been the RBI's presence that has determined a lot of the change in market moves. But in those 4 years, it was unable to do much, although it tried its level best to not allow the rupee to appreciate. But it couldn't. Basically, it just was like, oh my God, this is just too much for us.
So what you're saying is that the 46 to 39 happened despite the RBI trying to not let that happen.
Make it happen. And it's interesting because I think let's go back to first principles, saying why should a currency appreciate or depreciate? Maybe it's a very this thing. And Raghuram Rajan once talked about it, but I'll explain it in a different way. There's a dosa that's made in India. And we like dosas. Dosanomics in a way. So the dosa economics doesn't actually translate, but okay, let's go with this. Let's say there's a dosa made in India and it costs 100 rupees. Sure. And the rupee dollar rate is 100 rupees to a dollar. Sure. Right? Aspirational for some perhaps, but but not,
We'll come to that later.
But $1 buys 100 rupees worth of goods. A dollar in a dosa in the US is $1. Dosa in India is 100 rupees. All fine. A year goes by. Indian inflation is 10%. So the dosa goes from 100 to 110 rupees. In the US, the inflation is 4%. So it goes from $1 to $1.04. Because it's the same dosa in both places, what should the exchange rate be to compensate? The idea would be 100 to 1 and 110 to 1.04 is a ratio. So the rupee should become 105 8 rupees to a dollar. So it's a 5.8% depreciation in the rupee to meet the fact that there's an inflation differential in the two countries. This is a long-term phenomenon in the sense of if you take 20 years, like 2002 to 2022 or something like that, you're looking at an inflation differential of 4% between two countries and a 4% difference in exchange rates as well. This should be what what the theory says, because the US inflation I think has averaged 2%, and Indian inflation has averaged maybe 6% in the same 20 years. And therefore, this 4% differential reflects in the rupee rate. So if you look at 2009 to 36 rupees, 39 rupees to 84, so it's roughly doubled, a little more than doubled in about 15, 17 years or 18 years. 18 years doubling is roughly 4% a year if you look at it that way. So in that sense, you're right in that the differential of 4% has happened over the last 20 years. Now, I'll say this as an overall theoretical construct.
Yeah, because I need to jump in, because in a past life, I suffered through some international monetary theory type class where they had this exact point that it was either interest rates differential between the two countries or inflation, like you said, and that if one was higher than the other, then that currency would become stronger and so on. So why I'm jumping in is this is quite a symmetry, right? I'm saying we get 4% weaker on average every year. You're saying the inflation differential is 4% each year. So where is the RBI coming into this now? This is just our inflation differentials.
Which is true. I think this is a great point, because I think now I will proceed to do the worst thing that people do, which is ruin a good story with facts.
Okay.
So, which is that was theory, and because theory is theory, in practice, nothing is actually what theory does, or many things. So, a lot of things change. So, for instance, one of the biggest things would be, oh, what is this inflation you speak about? The inflation that in the US has is 2%. But is it really 2%, or was it really 2%? The answer to that is, you look at a lot of US economic history, they have tried to bring the headline inflation number down by using random adjustments. Oh, they said, oh, well, you know what, the price of beef is X. But when beef gets too expensive, people replace it with chicken. So we will take the price of chicken instead of the price of beef when the price of beef gets higher. So really, I mean, because most of the people will still eat beef, but the beef has become expensive and they're feeling the pressure of that inflation, but you're going to record a lower inflation number. Or you say, oh, well, I'm buying a cell phone today, it's the same price, or it's 10% higher than the cell phone yesterday, but this cell phone has a 5 megapixel camera versus a 4 megapixel camera. So you're getting 25% more megapixels. Therefore, inflation should not be considered 10%, it should be considered 8% or 2% or 3%. So US downplays its inflation numbers. India, on the other hand, has a weird problem that we have so much food in our inflation basket, because maybe the food basket is quite high. In fact, that's something to discuss in a different podcast. But the idea over here is that India inflates its inflation numbers, because at the core, the inflation is probably 3.5% to 4%. Now, people will argue every time I put these numbers on Twitter. People are like, no, my son's school fees went up 10%.
That was what I was going to say, but okay, fine.
It's true. It's true that in some pockets, inflation will always be higher. But remember, I am also paying 4 lakhs for a car, entry-level car. I paid 2.5 lakhs for it in 1997. Okay. And therefore, there is inflation that's different for some and different for the other. But having said that, that's just a different part of the argument. But I think inflation, India overplays its inflation numbers. So our 6% is headline inflation, but 4% is core inflation now. And core inflation being 4% or less than, in fact, at 3.5% right now. Our core inflation is lower than American core inflation. So if we use that inflation argument today, we would should be appreciating, and therefore, the 4% depreciation per year is not really a given. But I'm just saying this from the face of it. But
I'll interject here. So I take your point that there is some nuance to the inflation, but can you address the elephant in the room? What role is RBI then playing in changing the exchange rate?
So this is very interesting, because now we got to look at how this exchange rate is determined in the first place. A little bit of history, boring history. India, after it got independence, had no dollars at all, right? Fair. So we were sitting there, or no pounds, or very little pounds, and we had to import everything and all that stuff. So they kind of determined the rupee to dollar exchange rate at 4 point something. Then there was the China war, Pakistan wars. In 1966, there was a big issue. So we had to, depreciate the rupee from 4.6 something to 7.5 overnight. But this was not meaningful because there was no market. It was like, oh, when dollars came in, you went to the RBI. RBI said, okay, fine, we'll give you this many rupees. And that was an administered rate in a sense. Then Bretton Woods happened in 1971. The whole US architecture around the dollar changed. The world architecture around the exchange rates changed. So we got a little bit of a floating rate because earlier it was pegged to gold. Then it was not pegged to gold, so we got a little bit of a move. But by and large, till 1982, the rupee was just 7.58 type rates because very, very controlled. You couldn't get dollars to go abroad because RBI said, oh, if you go abroad, we'll give you $9. You do your trip in $9 and so on. It was very complicated at the time. So because of this administered rate mechanism, we suffered in different ways. And we didn't have any dollars. And to a large extent, some of the problems were like when you don't have any dollars, how do you get dollars to buy anything? You take a loan. So we go to America and say, give us a loan. Then we'll buy stuff from you because we need that stuff. In 1960 something, there was a famine. In that famine, we don't hear of famines right now, other than the fact that sometimes if you go to your favorite restaurant, your dish is sold out. That would not be considered
a famine. We've come a very long way, very happily.
Yes. So, but this did not happen. This has an interesting history to it. So in 1960 something, I think 66 or 67, there was a famine in India. India needed wheat. We weren't growing much wheat ourselves. So what happened at that time was we went to the US. And the US said, the US has excess wheat. So what really happened was they told us, we can give you wheat, but you have to change your political policy to align with the US instead of Russia in that sense. So India refused to do that or had to do something to do against it. But when we came back, we said, this doesn't make any sense for us to kind of depend on a foreign country for our wheat. And with the prodding of perhaps some international agencies as well, we built the Green Revolution to the point where today we are so self-sufficient on food that we have way too much food. The government spends 400,000 crores a year buying up the excess food for itself. Some of it rots and much of it sits in government things as reserves. We don't allow it to be exported. If we were to export it, we would get like I think a 20-25% drop in worldwide rates just because we allow it to export. But interestingly, we don't allow it to export because then farmers would choose to export their wheat rather than sell it to India, and we'd end up with the same famine that we were trying to avoid in the first place. So it's a very controlled kind of a mechanism. However, the exchange rate problem was because we didn't have enough dollars or rupees, because everybody wanted to deal only in dollars or pounds, and we didn't have enough of those pounds to pay. To that extent, things changed. It took a long time to come to where we are right now, and a lot of it happened in 1992 when we had no foreign exchange reserves and so on. This is kind of another part of this historical sequence. But let me start with now what happens. Now quick cut to what happens. Earlier it would be like when we went in, it was only the RBI. Now there's a forex market. In that forex market, a foreign player comes in and says, well, I want to give $100,000 and I want to buy rupees because I want to buy either real estate or I want to buy Indian stocks or something like that, or I want to invest in a business in India or something like that. What happens then is a bank in India will say, oh, well, fine, I'll buy your $100,000 and I'll give you rupees against it. And then the RBI sits on the other side of this equation and says, well, you know what? Give me that $100,000. I'll add it to my reserves. This is a reserve kitty that I'm building in case we need to import stuff tomorrow. So I will buy those $100,000 for you, and the RBI has the ability to print rupees. So it prints rupees against it and gives it to the bank, which then gives it to the person who's coming in. So effectively, the dollar is printed, allows India rupees to be printed because the RBI buys these dollars, and it's the elephant in the room because a very large chunk of almost all of the net transactions happen along with the rupee being printed by the RBI when dollars come in, and rupee being taken by the RBI, which puts the rupee out of circulation, and dollars given when people want to exit. So when you either import or when you do something else, that the other side of this happens. The RBI is this large factor, and we have $700 billion of reserves now, which is 57 lakh crores. Our GDP is about 350, 360 lakh crores. RBI has 57 lakh crores just sitting in dollar-based, reserves. And the rest of it is in other things. We can come to that. But what the RBI does is actively participates in the forex market, which it has created. Although it is no longer administered, it's not like, oh, RBI is determining 7.5 is what you get. It is a market determined price, but RBI is constantly watching this price to say, oh, it doesn't need to go this much or it doesn't need to go that much. To answer your question, how the RBI or how the rupee gets lower or higher in this, the equation changes because of RBI's participation, not away from it. So to say, put it in another way, what would happen really if the RBI didn't participate?
Well, I sort of get where you're going with this, but what my point would be, I would feel that if the RBI isn't involved, then the rupee would weaken very dramatically, surely, and it would fall to say 100 very soon, and people would keep moving their money abroad, investing in foreign assets, so on and so forth. So isn't their presence as a sort of stabilizing factor very helpful in this regard?
It's a very interesting thing to note, because there are lots of factors on RBI's, how RBI kind of looks at this equation. But let me just tell you this from another perspective. This is like when you don't have enough, there are three aspects to this. Why the RBI does this, and is the RBI doing this any beneficial? And is this going to continue forever? Is this how things happen? I think those three aspects should be looked at from a partly historical context and partly where the current situation is. If the RBI weren't to participate in this market at all, if dollars came in, the idea would be that the dollar would come in, somebody would have to buy those dollars and give the rupees against it. It would be an Indian bank. An Indian bank would say, well, you know what, you want rupees, there's more demand for rupees and there's supply of dollars. So the dollar rupee equation should be that rupee gets stronger, dollar gets weaker. And the same thing on the other side, when rupees go out, the demand for dollars go out, the demand for the dollar is higher, then rupee supply is lower. So the dollar should appreciate. So what you're saying is that, oh, more dollars go out than come in. Therefore, we should be seeing a depreciation. Yeah. The answer is that's not true, unfortunately, in the facts. So here's where, again, I'm ruining a good story with facts, but there are three reasons why there are flows in India. And we often look at, oh, we have crude oil, oh, we have this. But the whole equation is different. If you look at the facts, the current account deficit. So there are three reasons why flows happen. The first reason is because we import and export. Now we look at imports as we import crude oil, we import gold, we import semiconductors, a bunch of things. But we also export services. We export a lot of things from the physical end also. We sometimes import crude oil, refine it, export petrol and diesel. That's also a significant part of the So this part is one. There's another layer, which is that India's largest export is its people in that sense. When people go out, they have families back in India, they send the money back. These are remittances. This is $120 billion a year. So it's a very large chunk of everything. So because you have these remittances come in, and sometimes NRI deposits also come in, but I'll keep that separately because NRI deposits are when you put your own money into your account. Remittances are when you give your money to an Indian resident. So the difference between the two is one has to be returned, one has to not be technically. But the problem with looking at this is these two things form something called the current account. The remittances plus the trade for the most part. The current account has been negative in India for a long time, but in the last maybe 4 to 5 years, it has narrowed down considerably to a point where maybe it's about $25 billion a quarter. This sounds like a large amount of numbers, but remember, just the remittances are $100 billion a year, which is $25 billion a quarter by itself. So to that extent, our current account deficit is not that bad. It would have been much higher without remittances, but remittances will continue because we continue to have people abroad. Over a longer period of time, if you look at things in a split perspective, the third element that balances this out is the fact that foreign people want to invest in India. whether it's an Amazon setting up an Indian subsidiary, or whether it is a company in India raising money from abroad because those people want to do VC investments, or whether it is, these are called FDI, these are called FPI. The FPI is people who invest in the stock market. FDI is people who invest directly into companies, greenfield projects, set up their own subsidiaries and so on. This was nothing. In 1992, we didn't even allow most of this stuff, which is when we had the foreign exchange crisis from a historical perspective. And FPI was almost again next to nothing. Today, FPI and FDI are absolutely huge. This is called the financial account. Now, the financial account plus the current account plus whatever RBI participates is always zero. So we have a $25 billion current account deficit. That means trade plus remittances, net is minus $25 billion on a per quarter basis. Foreign investments into India, for the most part, are even higher than this, to a large extent, which if you look at just 2000 to 2020 to 2024, our current account deficit has added up to be about 124 billion, or so roughly that much. And the foreign direct investments and portfolio investments, FPI plus FDI, has added up to be $216 billion. Okay, I'll come to this figure later about why it's interesting. So what happens now is when we said that, okay, if your net outflows, the rupee should depreciate. If your net inflows, the rupee should appreciate. But who comes in? The RBI comes in and says, wait, I don't want the rupee to appreciate. And it goes in and buys all those dollars, and therefore creates a demand from the dollar from within the country, and therefore balances this out. Not just balances it out. The rupee went from 2020 to 70. January 2020 was 70 rupees to a dollar. Today it's 84. So it's depreciated 20%. But I'm telling you that we got 100 billion more dollars coming in than going out. The problem in my head is, how do we allow the rupee to depreciate from 70 to 84 when you had net inflows? But we did, because the RBI came in and bought all these dollars and more to allow the rupee to depreciate to 84 on the pretext of building reserves. And really, what did we build these reserves for?
So two things immediately come to mind. Maybe one way to look at it is that all inflows of dollars are not created equal. So if an inflow comes in for like goods and services, that's fine. But if an inflow comes in for an investment, like someone wants to buy this into the Swiggy IPO, that's not really here for good. I mean, if their money doubles, which hopefully it will, then they will sell and take it out. So it's kind of like a short-term inflow, and so you can't really count that as a permanent something you can hold on to. That's one. And the second thing that sort of like just came to mind is, if they're buying all these dollars and giving rupees instead, what happens with that? I mean, to those rupees, does that itself cause inflation, or do they have to soak it up, or what could they do?
Yeah, I think this is great two questions, because what are the first one? The
first one is that not all flows are created equal.
Yes.
So, I mean, all these foreign institutional investors who are now coming in, if the market doesn't do well for a couple of years, they'll stop coming in, and then you can't keep relying on that, right?
Yes. In fact, this is where it becomes very interesting. The way these flows have been determined have created the wrong metrics for us. According to me, if what you were saying was true, then the foreign investors would be constantly getting in and getting out, and it would massively hurt the rupee exchange rate all the time. So they would be, but then they have been the biggest non-promoter investors in our stock market since 1992. They built such a large position that they were half of non-promoter flows. That means half our stock market, which is not owned by the promoters, was owned by foreign institutions.
So if the market is like $4 trillion, there'll be 1 trillion or something like that.
So 50%, yeah, there'll be 50% is promoters, the 25% is foreign institutions, 25% is all Indians put together, including mutual funds, insurance companies, banks, and individuals.
So see, if they all take it out, our reserves aren't enough.
Yeah, which is true. But interestingly, they have been taking it out, and it's not made a meaningful difference. And even if they do, it's perfectly fine. I think we allow the rupee to, or allow the dollar to come in and go out in these cases. But when you create more freedom, more rupees have come in. Earlier, when you didn't have the freedom, I mean, 1970s, I think when foreign people invested in our economy, George Fernandez came and said, no, you have to list your companies in India. So the rupees went out. It was the freedom to operate the way they wanted was not there. But when you gave more freedom, more of them listed. Hyundai just listed in India. It was probably unheard of that why would a Hyundai, which is a Korean company, list a subsidiary that is Indian? Because there's more money in India from Indian investors that want to participate in this economy than there is in the US. A lot of companies have reverse invested. The Indian companies, which thought they should be listing in the US, even though their primary business is in India, have suddenly said, oh, no, India is a better market. So this has happened because I think the freedom to take out the money is also there. But here's the thing, the investment flows may not necessarily be permanent, but they will almost never be one directional over a long period of time. People will take their money out and more money will come in after some time. But the more freedom you create allows this mispricing when somebody rapidly takes their money out to be taken out by another guy from abroad also or from domestic sources who comes in and balances the flows out simply because this mispricing can't last for too long. So you take a company that is growing at 30% and you drop its price 70% from wherever it is. At some point, somebody comes in and says, this is ridiculous, we've got to buy it. And then the flows will come back in. So one is that the flows, while they seem like, oh, they can take everything out, almost practically it never happens. In fact, I would argue that this is a bigger fear in the US. If all foreign holders of US securities, whether it's debt or equity, were to take their money out, the US economy would be absolutely crippled. But that does not mean that they want to control their exchange rate by having the Fed participate in the forex market. The Fed participates in the domestic bond market, that's fine, because they want to control the supply of dollars. But they don't participate in the forex market. They let it be free because in the end, people are going to come back to the US because that's the hub of innovation and a hub of growth. India is also a hub of, well, growth, not innovation perhaps yet, but I think growth is a given here.
Yeah, fair. I think my point is the question was a bit provocative, silly and provocative because in fact the world is looking at investing here. It's the opposite.
I think that's so. What happens is, but I don't see that you're in a wrong place at all because this is how the RBI thinks. The RBI isn't like, oh, people want to invest here. No, people want to take their money out. Why do we have a limit of 250k USD per person as LRS limits? Although those LRS limits are less than 10% used on a foreign investment front. Because they're afraid that if I open up this limit, oh God, everybody will take their money out. Guess what? The LRS limit is not being fulfilled in any meaningful way by investments abroad. I wish it were, but it is not. And honestly, that should give the RBI room to say, listen, let's just open it all out. It doesn't matter because you know what? If you have the freedom to invest out, you'll probably in the end come back and say, why am I investing abroad if India is growing at 10% or 15% a year on stock markets versus something else? But you don't have that opportunity because they're more like, shit, if you open things, everybody will just sell their cars and go abroad and sit down. But that doesn't happen. And I think we have to admit that we're a more dynamic economy than that. But this comes from the history. In 1992, we had, they called it, 15 days of imports. So we've made those metrics, and those metrics are, I think, wrong in the sense that if you were to look at what we think, we have 6 months of imports. Now, let me give you the rough figure. Again, $25 billion
a
quarter of current account deficits. But these things are met fairly reasonably. So if you look at imports from a net import perspective, we are probably maybe $40 billion a year, $50 billion a year. Net imports are lower. So $50 billion a year, you have $600 or $700 billion. That's 12 years of net imports, including remittances. So the $25 billion trade deficit per year. The current account deficit is probably lesser at $10 billion or so. 25 billion is the trade deficit. Now the trade deficit that I talked about, 12 billion out of that 25 billion is crude oil imports. 8 billion is gold imports. So we're talking over 20 billion out of this, which is not really price sensitive in that sense, right? So increasing the price of gold does not necessarily mean that people will buy lesser gold.
They probably buy more.
More gold, yeah. Right? Because if the price is going up, we should buy it before the price goes up even more. So it's an investment. Crude oil, you can't stop going to work just because the price of petrol is up by 1 rupee. And anyway, it's administered in India in a different way. So technically, we are price insensitive on two of our largest import numbers. Net of that, it's nothing. So
imports won't change, but won't exports be stronger with a weaker currency?
Yes, that's what, in fact, RBI looks at this very, again, the metric is look at exports rather than imports. Okay, so what would happen with exports? The problem with exports is, I think RBI looks at this and says, Shray, if there is a massive weakening by Indonesia of the rupiah, vegetable oil becomes very cheap, Indian oil exporters go bust, because they can't survive anymore, because they can't export, because Vietnam is supporting Indonesia is doing everything. So then Indian oil also becomes more dependent on Indonesia, because the Indian oil exporters were also Indian domestic oil manufacturers. They also can't find a market because their oil is cheaper. So India then says, well, you know what, we want to depend on this. And unfortunately, when we come to something like this, RBI determines that it also needs to participate and weaken the Indian currency so that our exports are stronger. But Indian government is also on this case and saying, listen, if this happens, I'm going to introduce tariffs on Vietnam and on Indonesia and so on for its oil. So we'll try to increase the price of oil in India for those people who are exporting here. And at some level, those tariff barriers, in a way, kind of balance out that equation. But RBI also participates by saying, I'll weaken the Indian currency. Let me just keep on buying dollars to the point where the rupee becomes weak so that Indian exporters can be
competitive.
There are other complicated non-tariff barriers. So for instance, when India, like I was saying, dosa, the dosa, why is it not the same price? There is no price linkage between Indian dosas and American dosas. There are two reasons. If you make a dosa in America, it's impractical to bring it back to India if there was a difference in exchange rate. But leave the practical considerations aside. Let's say you were able to do so. America will say, no, we're not importing food items from India. It's not about tariffs, but we think your food is contaminated. The minute you say that it's a non-tariff barrier, we won't give you visas, it's a non-tariff barrier. We export people in that sense. So, oh yeah, well, fine. That's one way to do it. So what we do is, because we don't have any way to meaningfully say non-tariff barriers, we say, oh, well, we'll put tariffs on you. So if you sell your cars here, we'll put 100% tariffs. So those barriers exist and they kind of violate the trade flow argument of free exchange rate, being determined by the difference in inflation between two countries. But when we come back to something like this, how do we measure, therefore, what our dollar reserve should be? We've used net imports. I think that's a bad idea because our net imports, we use gross imports. So we say, oh, we have 6 months of imports. But if you look at just imports, that makes no sense. Goods imports, that makes no sense, because we export services, we export people, we get remittances. Can't we take something net of all of that? We might find we have 12 years of imports, which is high enough for most people. The second big thing on this aspect of things is that we use something called an REER, which is the real exchange rate of the rupee or something like that. This effective exchange rate of the rupee. This is a metric designed in, I don't know, some place abroad when people only used to trade merchandise, most likely. So they would take all the merchandise export or trade between two countries and determine the differential in those terms, and then come to where the rupee is has it become stronger or weaker compared to the merchandise trade between multiple countries. But India is a merchandise trade importer. We know that. So our equation is going to be lopsided. But if we took services, would that not change the equation? The real effective exchange rate would actually change quite dramatically if we were to take the services and invisibles as part of this equation. But we haven't, because this metric was not designed in India. This was designed somewhere else, where invisibles are considered tiny and not inconsequential to the whole thing. So therefore, you don't consider that as part of the real exchange rate. So according to me, the REER is a flawed metric, but we follow it because it's followed worldwide, and therefore say, oh no, the rupee should be stronger or should be weaker because this metric says it's strong. But if you change the metric, it would probably be weaker. And so I'll give you the simple example. $216 billion came in. $120 billion was the current account deficit, and yet the rupee went from 70 to 84. This makes no sense. And the part that you mentioned about the fear of flows going out, you said this at some point. They own $1 trillion worth of rupees. We don't have $1 trillion.
Of
Just
assets, of stocks, yes.
And I'm not counting the real estate, the other stuff, the unlisted companies that they own. Just in the public markets, they own $1 trillion. We couldn't pay it back. And I will say this, we don't need to. We should not think that we need to pay it back. Because should all of these people exit, are you going to allow them to? Most likely you're going to say, sorry boss, wait. Whatever you're doing is silly. So we will now stop everything and we will talk about why you guys want to exit. And we will not allow you to. Russia did this because when America sequestered its currency, it was not like Russia said, oh, well, all you American companies who have investments in Russia can now take your investments out in dollars and we'll give it to you. Russia said, nothing doing. Just you guys figure this fact that you sequestered my currency, and then we will talk to you guys about what you can do with your investments in Russia. Maybe you've lost all of it. That's fine. India will do the same thing. All of you want to exit at the same time, something is wrong. And therefore, it doesn't make any sense. So I think leading on from our last episode on FPIs as well.
And I wanted you to bring you to this thing is that when the RBI buys these dollars, it has to print some rupees, right? Or what happens with that? I did want to come to that.
Yes, I think that's an interesting point because now this is the negative part of it. Like I told you, there was, in I think 2004 to 2007, the time when the rupee appreciated, there was a massive inflow of dollars. I think 50, maybe $100 billion came into India in maybe back then. And that was a huge amount. I mean, $100 billion was massive. Today, $100 billion is not as massive. So the RBI doubled its holding of dollars. It had maybe 100 billion or less. Before this, it doubled it to 200 plus billion dollars. It was a very large number at that time. And despite that, the rupee appreciated. And when you introduce 500, 600,000 crores more of rupees into the system, obviously you're going to create inflation. Now, this is an interesting aspect because when the RBI as a central bank prints more rupees, it buys dollars, it prints more rupees, it goes into a system. That banking system is starved of money for the most part. And when you give that money into a system which is starved of money, because and you can find out if the system is starved of money by looking at RBI statistics on a daily basis and saying whether the system is on a surplus or a deficit. This has had no meaning to India because we were always in deficits. The banking system always wanted money to lend out. There was not enough money and there was always daily borrowing from the RBI and so on. When you have a system like this and you introduce more money into it, the credit growth keeps inflation very high. Your credit growth was 25-26% at this time per year. Credit was growing at 25 to 26%. Bank chairmen were coming on TV and saying things like, oh, if the Indian GDP grows at 8%, we will grow at 25%. It was not we will grow at 25%. It was credit was growing and more money, rupees were being printed, fueling more credit growth and so on. The demand for rupees was very high and inflation was being created like this. Typically, when you do this, it has a 6 to 18-month lag between the rupee being created and the inflation actually appearing in the system. So by 2007, we were seeing 7-8% inflation rates. I mean, slowly it was going towards that. And the RBI was very worried about this. And what it did was then it said, listen, there's too many rupees in the system. We need to take it back. But how do you take it back? You tell the banks, don't lend out the rupees effectively. You give it to me, those rupees, and I will give you 8% on it, and I'll take the rupees out of circulation. Because when banks lend it out into the regular system, that creates more money effectively downstream. Because what they do is they lend, and that person who receives the money goes and spends it on something. The person who receives that money takes another loan, and it kind of multiplies itself. But when RBI says, listen, give me that excess money, they take it back as excess reserves, and they used to pay relatively high interest rates on it. But RBI doesn't pay anything. The government pays it. So the government had to issue what are called dollar stabilization bonds, and those dollar stabilization bonds had an 8% interest. And guess who paid that interest? You and me as taxpayers effectively paid that interest over a long period of time. It is not small because interest payments today are the largest single expense of the central government. which is now become 2x of the defense budget. America is cribbing that it has become some 90% of their defense budget, their interest payments. We are 2x and going higher. So higher interest payments by the government then also fuels more inflation. I'll tell you why. Because when the government needs to borrow more and more to pay for its interest costs and all of that, each of these items then actually fuels into inflation at a later point, because the government spending is not actually creating any meaningful value. It's only paying interest to its on its borrowings, and that deficit will keep widening because you need to borrow more to pay interest, you need to borrow more to pay interest, and so on. So this inflation creation is a big problem when RBI participates in the forex market, and it has been quiet for maybe 2 or 3 years in the middle. Other than that, it has always meaningfully participated in the forex market. And to come back to the contemporary time, the last 5 years, it has participated in a massive way, both on inflows and outflows. It has decided that it has the takeout of the rupee is for me. That means I am responsible for the rupee's movement, and at some level, on an everyday basis, if rupee is going in or rupee is going out, the RBI is participating almost on a everyday basis. So if $100 billion went out, most of that $100 billion came from the RBI itself, from its reserves. So the reserves went down by $100 billion. And when dollars came in, to give you an example, Reliance did a massive fundraise just around 2 months after COVID, probably of the order of billions and billions of dollars. All those billions of dollars went straight and sat into the RBI's kitty. Even though at that time we weren't importing much crude oil. There was almost no imports. I mean, you weren't allowed to leave your house. So what would you do with crude oil at that time? We weren't, the current account deficit there was a current account surplus for that quarter. And yet the RBI would go and buy this because it was like, oh, my precious reserves. So at some time, though I'm paraphrasing and perhaps I shouldn't be so hard on the RBI, I think this inflationary aspect of these things has kicked in. I will put a caveat there. RBI printing rupees doesn't always result in inflation. One of the times it doesn't is when the system is in a surplus. That means banks don't want to lend. Credit growth is at 6 or 7%, right? Like right now. So we've got a lucky streak of 4 years in which banks have been constrained to lend because they're afraid of defaults. And anytime that they push their lending, RBI comes in hard on them. Say, oh, how come you're lending so much on credit cards? Slow it down. How come you're lending so much to unsecured personal loans? Slow it down. So in that sense, RBI has also curtailed the credit growth in the system while adding more to the rupee supply. So they managed to curtail it to a certain extent. But it's like a system that is, you've created the monster and now you're trying to put chains around the monster at all points. But it's a monster and you have to stop it at some point.
So I think to frame your argument, when the rupee has the ability to go higher and become stronger, the RBI doesn't let it by accumulating reserves instead. In the process of it issues, I mean, it creates rupees which could potentially fuel inflation, but and so on. So I do get the point. But then what are you advocating? That they basically stop? Then whose responsibility is the rupee per se? Is it the central government's? I mean, the central government can do it if it wants now itself.
Well, that's actually, there are two interesting points over here. Is the central government involved? And secondly, should the RBI just stop? I would say one of the problems is that we have a FEMA. And that FEMA is a law that almost says RBI is allowing you, Shray, when you go abroad, to spend dollars on your credit card by being benevolent about it. Because the FEMA is a law that says, boss, your foreign exchange does not belong to you. You therefore have no right to spend any of this unless we approve. So in that sense, the law allows the RBI to frame laws that says, well, you can't do this and you can't do that and you can't. So they've done this by and large feature of saying, you can't do anything except what I say. And that walled garden is what we operate in today. And that walled garden has slowly been broken in chunks in many ways. But by and large, that walled garden exists. And to that extent, RBI gets its power from the laws that allow it to do so, right? FEMA empowers RBI to whatever draconian-ish measures they may be in it, they allow the RBI to push it to the absolute extreme. And RBI then says, well, we don't need to follow it to that extreme. Maybe we'll follow it to a lesser extreme and so on. So to the extent that RBI has therefore been given all these powers, it feels that it needs to be in control of the rupee dollar equation. And to a very large extent, it's taken its job way more seriously in the last 5 years than it has earlier, where the rupee was allowed to fluctuate a lot more. Now the rupee it fluctuates in a very, very small range, and it does not reflect economic realities of flows and economic realities of dollar differences in inflation, because the RBI now determines where it has to go. If the RBI were to stop completely, I would say first there will be an outflow of dollars. Let's say you repeal FEMA completely, right? And said, okay, forget it. Let's just let the rupee float freely and we don't care. The first thing that you might see is a lot of people will say, I'll send $100 billion or 10 billion. Then after that, they'll be like, where am I going to send this? Like, Europe is dying. Japan doesn't like foreigners anyways, because for whatever reason. And then they are also like growing older and all that stuff. Britain doesn't know its head from its tail for the most part. And America is a great place, but there's more growth in India because we have just a much wider footprint to begin with. And people abroad are saying, wait, I can take my money out whenever I want, how much ever I want. Why don't I put more money in? The more money will flow in than ever before. So we should be fearing appreciation, not depreciation. And why do we fear appreciation? Is because we make commodity stuff like vegetable oil for the most part, right? It's like you could replace us with somebody else easily, and then everything would be the same. But that's not true of a lot of American exports. It's like if you buy an Apple iPhone and you pay more for it, it's not because I can find a cheaper phone. Of course I can find a cheaper phone. We do use cheaper phones, but the iPhone has its own attraction and a big fan following. So you are able to price your stuff higher because it's better, or it has a perception of being better. And whether it's a Mercedes-Benz, a Porsche, a bunch of things around the premium ecosystem, we don't manufacture much of that here. Maybe we do a little bit in gold, jewelry, and all of that stuff. But by and large, we've not built our products to be better. So a lower rupee exchange rate would not matter to someone who has a brand. I'll give you an example, Haldiram's. The rupee could be at 50 to a USD or 100 to a USD. It won't matter because the guys who want Haldiram Bhujia, mostly Indians abroad, but possibly non-Indians, enough of them, and plus non-Indians as well. Indian food is one of the most popular things in the world, and those people will order the Indian spices from here, regardless of whether it's at 50 rupees to a dollar or 100 rupees to a dollar. You will want that stuff because, dude, it's not price sensitive. It's stuff that we like. We like the Haldiram's brand. We will buy it. We like the Bikaner Wala or the Bikaji brands. We will buy it regardless of what the price is. That is an example of something that we made in India that you could sell at any price abroad and it would still kind of have some demand, because you're not going to buy an Indonesian brand of bhujia just because they call it bhujia, because Haldiram's or Bikaner Wala has a bigger, this thing. So those kind of things are what we are going to be going towards as India is, right? And we don't recognize that for the first time we have the chance of building those worldwide brands, and therefore the rupee dollar equation may not matter to our exports as well. I already made the case that it doesn't matter to our imports. Our imports are going to be the same regardless of whether the rupee dollar is at 70 or at 60 or at 50, because gold is gold and stuff like that. But I don't think exports will also go down that direction of saying that it doesn't matter as much. And a freely floating rupee will actually push forward this mechanism. So RBI doesn't need to stop, it needs to slow down and needs to not constrain us as much as it has. So for instance, you can't invest in a mutual fund in India which invests in foreign stocks. But you could take your own money to a foreign broker, 250k USD per person, and buy foreign stocks
per year.
Now, this sounds ridiculous. Why do we have a $7 or $8 billion limit on Indian mutual funds buying US stocks when the money is in India and the US stocks are controlled by an Indian mutual fund owning thing. It's actually an Indian asset. Why should RBI own on the dollars? Why can't people own the dollars? It's the same thing. You still have so instead of 8 billion, make it 50 billion. And the last outgoing Shaktikanta Das said that we would like to encourage this phenomenon, but we fear for the US dollar equation. I'm like, no, that's the wrong thing. It's the same thing if I own the US dollar, and if the RBI owns it. The RBI doesn't need to own it. It's a representation of us, the people. If I own gold, it actually means India owns gold, right? So it's in that sense, in a way that's available in India. We've taken all the gold imports and called them imports. But no, they are financial assets. They should be considered as assets of the country, but we don't consider it so. We don't consider that my owning a US asset through an Indian mutual fund is an Indian asset. Indian ownership of foreign assets. I think if the mindset changed in that direction, you would find that the RBI would be a lot more free and said, listen, I don't need $700 billion of reserves on my balance sheet. It could be 500, and you guys own $100 billion of the assets. Maybe I'll make it 300, and you guys own $300 billion of assets. It's as the more free I make it, the more of those foreign assets we control. And guess what? We are proud of the fact that the Tata Group bought the Jaguar Land Rover brand, because it's a worldwide brand which we own now.
Before they rebranded it, I think it may not do very well as of last week. But
the logo has problems, yes. Yeah. I mean, we might differ on but the fact is they still own it and they can change it back. There are a lot of worldwide brands that perhaps we should own as well. I mean, I'm just saying that we would own a lot more of them if we were allowed to do so, and we could own them through our mutual funds. Why can't we? And why should only a Tata be allowed to buy a Jaguar? Why can't us as a country? I think that is going to make the difference between where we are and where we go.
I have a thought immediately. I mean, and you can continue otherwise, which is that imagine this conversation or some version of this does make it in front of someone at the RBI. I would think that an immediate response would be, look, Deepak, you're running a small PMS out of Bangalore. We are sort of making sure the country is functioning on a paradigm we've been doing for many decades, or many decades. Isn't this like an insurance where maybe you're right, and so maybe I'll gradually feel my way towards there, but if I'm wrong, we could have a horrible financial crisis of some sort, and it's not like they can come back to you then saying, Deepak, I mean, you are wrong and oops. I mean, so in other words, does this conservatism help us for a rainy day event, given that the economy is doing all right anyway?
Shray, I mean, I think conceptually I have this distaste for this, and maybe this is perhaps an interesting way, maybe philosophically also. There was a Tina Turner song in 1980 something.
Never heard of it, but please go on.
It's a song called "We Don't Need Another Hero. We Don't Need to Know the Way Home."
Definitely haven't heard of it.
Yes, so it's a very the line doesn't go away for me, because it's like, if you have someone who has extreme oversight on everything that you do, you are constrained by whatever that person has in their vision. If you open things out, things are great. And there's this fantastic line. I mean, I keep saying this. I know I've written tomes about this, but maybe I'll come to it later. And maybe this is why I feel that RBI is being overpoweringly huge in the dollar exchange market specifically. Is that if we were to buy insurance, wouldn't we buy it with a small percentage of our money? And I say this quite seriously, because if you're buying a 1 crore insurance, you're paying 30,000 rupees. That's 0.3% of that. That makes sense. But when you have 57 lakh crores in USD of an economy that generates a value of maybe 350 lakh crores, it's not small. The insurance premiums you're paying on a regular basis are substantial, 1, 2, 3% of your GDP on a yearly basis sometimes. $100 billion is 1% of maybe, probably 2 or 3% of our GDP, and $100 billion is easy movements for RBI every year. So you're spending a lot more money on this. So the second interesting thing is, this does not accrue as profits to the people. I say this because when RBI buys and sells, technically if I bought the dollar and the rupee was at, 50, and then I sold it when the rupee was at 70, technically this 20 rupees is a profit to the RBI, but the RBI for I think nearly almost all existence refused to recognize this as a profit. So the central bank has a bloated balance sheet. It's generating profits, but it's not. No other country allows its central bank to make so much profit and keep it. So the RBI keeps 20 to 25 lakh crores in reserves because this is the generated profits.
Other than the forex reserves.
No. So forex reserves are on the assets, reserves on a balance sheet or on the liability. So they're a little confusing. So the point is that RBI generates these profits, and these profits are retained inside of the RBI by saying we need a contingency fund. For what? The contingencies are all taken by the government. You should be paying these profits to the government so that they can take care of the contingencies when they actually happen. But RBI says no, and they change the accounting policy a little bit to say, oh, well, you know what, we can't be so stupid. So let's be a little bit less stupid and recognize that when we sell dollars, we have to recognize profits. Since then, the RBI's dividend to the government from 60,000 crores has gone to 200, 300,000 crores. But they have 22 lakh crores, which is more than our current account, our entire fiscal government deficits. It's 1.5 times our government deficits. As sitting on the balance sheets as effectively retained profits. No other country allows its central bank to own so much as retained profits. But we allow it. And what has happened? It's because of the RBI control of the rupee. They've controlled the rupee or tried to control the rupee so much that they've generated all these transactions, they've generated profits, now created a bloated balance sheet. Oh, we can't give it to the government because you will undermine RBI autonomy. No, you're not. You were not supposed to be so autonomous as to be running a government size deficit 1.5 times the government size on your balance sheet as excess reserves. It makes no sense at all. They should be paying this out to the government, but we don't. But if we did pay it out over a period of time, the government would benefit. Our deficits would come down because we'd have lesser interest payments to make. We would actually benefit as a country, and you would not need to control the rupee so much because let's say we repeal FEMA and go on. So in a sense, if the RBI's insurance arm has been literally like saying, you could sit inside a room all of your life and therefore never be exposed to air pollution and traffic and maybe never get run down by a car because so many people are getting run down by cars. I would say that my freedom beyond that room is more important than being in that room and getting avoided from those accidents. I think at some point, this is another movie dialogue, which is something I keep quoting. Finding Nemo, Dory, who's a fish character in that movie, and there's this guy who's Nemo's dad who's crying because he can't find Nemo, and she asks him why he's crying, and he says, well, I promised his mother that I won't let anything happen to him. And then Dory goes and says, that's funny, or that's strange. If you don't let anything happen to him, then how will anything ever happen to him? I think that's what I say with the insurance, that maybe you should let things happen to us so that things happen to us.
I'll now take this back to my beginning questions, which is, I've got through the mechanics of this. Now as an investor, as a customer, do you think I'm condemned to be 4% poorer in dollar terms every year? And given that, shouldn't I be making use of this $250K per person per year, which is quite a bit, to invest in foreign stocks so that I can be richer over a medium period of time?
So I think the 250K per person should be done anyhow. If you have that kind of money, you should also
however much you have.
You should do that anyhow because there is a lot of innovation abroad. What's happening right now? There's AI. Who's doing AI work? Almost 90% is happening in the US. There's autonomous cars happening in the US. China has fantastic EVs. Of course, their investable part of their population is less for foreigners and us particularly. But they have done some amazing strides in electric vehicles, and so has America and perhaps a little bit of Europe. So you are getting a lot of the innovation on new things that is coming outside of India. So I think in any case, you should have some portion of your portfolio outside of India. There's certain things you can't invest in India anyway, like crypto, perhaps. For whatever it's worth, it's a good speculative investment. So if you want to make those investments, you can't make them from India. So you should do them abroad. And there are ETFs now that allow you to participate in them and so on. So given this, I would say the larger part of this thing is definitely do this anyhow. But I don't think you'll get that 4% appreciation anymore because of multiple reasons. One is, and this is where it gets interesting. As I said, the core inflation in both countries is roughly equal. There's also a Trump who's coming in and saying, listen, we'll do 25% tariffs. Dude, that's going to increase your inflation in comparison with ours. So we will, you might think the rupee should depreciate, but my thing is, no, shouldn't the rupee appreciate? Because the inflation is higher there than here. We don't care. We have high tariffs already. We don't want to increase our tariffs even more. But yeah, you're going to introduce tariffs, that's fine, because it's not going to affect India as much. So should the rupee appreciate or depreciate? But it will depreciate because of flows initially, but eventually the economics have to work out. The second part is India's naturalized inflation has come down because we manufacture more here, our logistics is getting better. You can order a shoe from Punjab today, in 2 days it will land up in front of your house. You can order a pencil in 10 minutes. These efficiencies have changed the way inflation works, because your pencil was earlier more expensive and would reach you at a much more delayed time if you had tried to do this, say 10 years ago, compared to what it is right now. Today in the morning at 6:20, my son says, I need to give a secret Santa present to somebody. I do a transaction on my phone, and before 6:30 it is in my house.
So before the bus comes.
Before the bus comes. I find this remarkable, and I'm paying a lower price today than I would have paid at any other time, and though I would have paid a premium for this. I find this incredible that we can do this in India. But what is this going to do? It's just going to reduce inflation even more, because the guy who's manufacturing those pencils is saying, listen, I'm seeing a lot of demand for my pencils. I'm going to make more pencils. And more people and that person makes more. As they increase the number of goods that is produced, the value of those goods in rupee terms does not increase as much on a per pencil basis, but as a whole, we're actually producing and selling more pencils. And more pencils are reaching more people who you didn't even think they would have pencils in the past. And now, suddenly it's... So I think these factors reduce inflationary pressures in India because you're increasing supply sides. And the demand side has always been high. And so even the demand growth is not as much as the supply growth is. So you're going to have lower constraints on inflation. America, on the other hand, is a slowing economy from a aging perspective, and also because their problems with their own economic like they've printed too much, they have borrowed too much. Those problems come to roost now. And I think the dollar inflation will continue to be high. Rupee inflation will continue to be low or controlled. We will actually see a much lower differential.
Might even be appreciation. If it's allowed.
I'm saying this because you have this big specter of the RBI saying, if you try to appreciate the currency, I will come back and I will, burst your balloons. But I don't think that, the natural tendency now is for the rupee to appreciate. In 1992 or so, there was a big fight between George Soros and the Bank of England on the pound. The Bank of England wanted to keep the rupee, the pound artificially high, and was trying to prevent the pound from depreciating, right? The exact opposite of what the RBI is doing now. And Soros said, no, it needs to depreciate. And then he made $1 billion bet or whatever. He made a lot of money on that. I would say right now, the bet should be in the other direction in India, where the RBI is trying to artificially inflate the dollar, whereas the rupee is naturally getting stronger and stronger and stronger. So if you were in a position to play this out, I would invest abroad for their innovations, but not because of their currency.
Deepak, one concern I have is that if you do, however, completely open up the rupee per se, won't this create a whole lot of volatility? Like, we have just been trying to get lakhs and tens of lakhs of people off F&O trading. And now if you open up the rupee for speculative trading, won't there actually be a lot of speculation, a lot of gambling, and this will be then highly volatile and could move in ways that have no reflection of the economic realities?
This is a great interesting point, because speculation is probably what people fear has caused, let's say, the Asian economic crisis and so on. But I think the overall concept is this. India is in a very interesting position, where like I keep saying, India is actually getting more inflows than we are getting outflows. Overall, the overall account gets a lot more inflows. And we have at the same time stopped speculation because FEMA doesn't allow it. So till earlier this year, a lot of currency trading used to happen on the NSE and the BSE in India. So you could get a forward contract, futures contract of the rupee dollar very easily. There were options on them and all that stuff. Suddenly in April this year, RBI said, no, we can't do this. And it wasn't because they didn't want you to do this per se, because they were the ones who allowed the market to happen in the first place, but because they read a rule in FEMA that said anyone who allows speculative trading of the rupee is therefore illegal. That's somehow a criminal offense.
You needed some invoice or something.
You need an actual, like, it can't be speculative. It can't be like, oh, I'm betting on the rupee going down. It has to be, oh, I have some dollars coming in, therefore I want to hedge it. I have to have it backed by some physical invoice or some exposure, if you may. And if I have that exposure, I can prove it. I can't, for instance, I even tried the stunt of saying, can I say that I use my car for 5,000 kilometers every month? 5,000 rupees worth of petrol or diesel every
that's
month.
More reasonable.
Can I just say I can expose myself to $100 worth of, no, but apparently that doesn't work. So it needs more this thing. So, but because of this, what has happened is the speculation continues because they created a product called a non-deliverable forward. NDF. So the non-deliverable forward is like this. In London, people said, hey, they're not allowing us to play in the rupee in India. Oh, okay. Can we not play the rupee here? Well, how do you do it? No. You know what, Shray, why don't you tell me that you want to buy the rupee at, 84 rupees to the dollar, and I will sell it to you. And the next month, we'll figure out where the rupee is, and you pay the difference. So if
this
it's
is dabba trading.
This is dabba trading. Well, dabba trading in suits is NDF.
Okay.
So you essentially don't actually pay me rupees and I don't pay you dollars, but you just pay me the difference in dollar terms, right? So you just say, oh, well, so then you're betting and I'm betting and I'm fine with it. And the RBI is looking at this and saying, hello, this is my rupee you're talking about. And then they're like, yeah, you don't allow us to play there, we'll play here. So, other players are looking and saying, hey, wait, can we do this? Can we do this there? Can we buy a non-deliverable forward on the rupee? Because I don't want to go to India and prove all this documentation bullshit. So can I just play here? So even the guys who have exposure are doing the NDF because they don't need all the procedures. Suddenly the RBI sees speculative transactions happening in the NDF market of the order of, 100 billion or 50 billion or 60 billion dollars there versus what could have happened in India.
Or just at any point of time?
This was a position at some
size.
point.
Okay,
so probably 150 billion dollars. Now they're like, $150 billion being traded. Come on, that doesn't make any sense. But no rupees or dollars are changing hands from India.
Yeah.
It's some fellow outside doing something outside, and so RBI suddenly decides that it wants to participate in the NDF market. So I'm trying to get my head around this because it's like, oh, wait, I'm a largest player in the domestic onshore market who pretty much determines the rate of the rupee by my actions. That rate of the rupee is used as the dabba interface for determining the price of a dabba contract called NDF in London. And then I go and participate in that NDF market there because I'm like, why are you guys poking your nose into my business? I will play because you allow everybody to play. So the RBI has gone and set up a $50 billion short position. Okay, let's $60 billion short position in 2 months. Now everybody's worried about this. And I'm like, wait. You don't understand. This is dabba trading. No dollar leaves RBI meaningfully. How much does it leave? If 84 becomes 85, and let's say the RBI has a $100 billion position. This sounds huge, $100 billion. But how much does the RBI lose if the rupee goes from 84 to 85?
Probably like 1 billion or something.
Okay? Yeah, it's about 10,000 crores. 100 billion rupees it loses because you have to pay the difference. 100 billion rupees is 10,000 crores. 10,000 crores is $1.5 billion, $1.2 billion. Now, $1.2 billion is nothing. So it's a leveraged market. NDF by definition, it's dabba. So there's no actual physical trading. So if the rupee goes to 90, it loses 60,000 crores, which is about, say, less than $8 billion or $7 billion. That again is nothing. So if the RBI were to allow the rupee to weaken to 90, it would end up losing just $5 or $7 billion. But why would the RBI allow the rupee to weaken to 90? It could, on the day of the settlement, sell a truckload of dollars in India and let's say $10 billion and automatic, because the market doesn't trade that much. If a $10 billion sale comes from the RBI, the rupee is going down, the dollar is going down 2 rupees, right, straight away from there. If you can do that on the settlement date of your own contract, you are therefore in the power to tell the NDF players, guys, don't screw with me, because if you do, and if it's too bad, I can bring the rupee down and you can lose a lot of money. You guys have bet 100 billion. I can make you lose $10 billion by moving the rupee in whichever direction I want it to move. It doesn't do it right now, but I'm just saying this is incongruent. It's crazy. But it's only the RBI doing the speculation. And there's so many other concerns. Oh, will I lose my reserves? Why not let all of us in India also participate similarly? I don't think it will be the same as F&O and I don't think there's anything wrong with speculation. I think you should increase the need for leverage. So, for instance, allow me to participate if I'm rich. Make each contract, instead of $1,000, make it, I don't know, $100,000. So that only if I have 5 lakh rupees or 10 lakh rupees can I play the forex market. But let me play, because if a lot of people like me participate, even though it is speculation, there's nothing wrong with speculation, we will get a much wider market, and RBI does not have to be the only guy, the hero who protects the rupee, because you should not have a non-deliverable forward market in London that has all the participation. Build it in India. We did this with the gift city. There was a Singapore Nifty called the SGX Nifty. That was the biggest source of speculation on the Nifty outside of Indian shores. India was like, why are you doing this? Why don't we create a gift city Nifty? Now there's a gift city Nifty that's as popular and is the biggest source of Nifty speculation outside of India. But the similar way, we should allow the rupee speculation to happen in India. I say that yes, there will be speculative flows, but you can't avoid it, because they will create dabba trades outside of India regardless, right? So you might as well build that market in India. And I don't know why we have done this. Maybe it requires a repeal of FEMA, but we should do it. And we should allow more speculation to happen, because, like I said, if we have to have something happen to us.
So, well, thanks so much, Deepak. That's a fascinating discussion.
Fun, and I hope I hope a lot of these things happen. Let's see where it goes. It's going to be an evolutionary task for us.
Well, everyone, thanks so much for listening. If you like this episode, then just visit us at Capital Mind on YouTube. Search for the Capital Mind podcast on, say, Spotify, Apple Podcasts, or wherever you like to listen to them. And do listen in for more episodes, both audio and video. Thanks so much.